Please press the spacebar on your keyboard to advance through this presentation. Press the back button to return to a previous slide or to review a particular point within a slide. Welcome to the PowerPoint tutorial for the newest application T3, TAC Trade Template, brought to you by Fulcrum Shift Trading. Fulcrum Shift Trading, shift your thinking. Instead of your typical buy and hold investment, let's analyze a very progressive approach to acquiring shares of SanDisk using an option strategy within a proprietary Excel trading platform called the T3 or TAC Trade Template. We begin by populating the platform. All areas in gray are user-defined. Also important to note, the month number, position duration in months, and outcome are also all user-defined using drop-down menus. These are shaded in unique colors as they represent different steps within this strategy. SanDisk is entered along with the starting capital of a hypothetical $100,000. There is a drop-down menu for your individual margin. Each brokerage firm is unique, but the standard is 2-to-1, which is what we will be using throughout the balance of this PowerPoint tutorial. 2-to-1 has now been populated in the margin field. Beside that, we have populated the number of positions field with a hypothetical 5. This is referring to a trader or an investor who wishes to build a portfolio of positions using this specific strategy. This is an important value, 5 or whatever value you select, as it is a function of the optimal number of contracts/shares you should be trading. This application automatically calculates this value, otherwise known as position sizing. The progressive leg BE or break even to support is a crucial metric not found in other option platforms. This will be explained later in detail, but essentially as the strategy evolves with the market, these values represent the distance between a technical support level on a chart relative to your current strategy break-even or BE levels. We populate the platform with the current value of SanDisk, $35.75, and because we're willing to take assignment of this stock, our first step is to sell an October put contract with a strike price of 33, collecting 73 cents in premium. The month number and position duration in months, as previously mentioned, are user-defined variables. Both use drop-down menus. The position duration in months refers to how far out the option expiration is relative to your start date. This is important because the length of time you define here affects the annualized returns. One of the great things about this application is the visual representation of the numeric values. The progressive leg price will populate in this graph in black with each step of this strategy. The progressive leg BE or break even, which factors in the premiums collected for a credit, is shown immediately to the right in brown. Here is the chart support level visual that we populated earlier here. This is very useful to see graphically because as the strategy progresses, it keeps us aware of how far away or below our evolving position with the credits collected is relative to what we initially defined as a technical level of support. By checking off the individual net profit loss in the bottom chart, one can see graphically each step's profit or loss. Here we can see the $511 profit, because in this example, the options outcome was populated with expired worthless by the end user, which is correct. Expired worthless is the correct outcome because in this example we sold the 33 put strike, and on options expiration we populated the ending stock value field with a value of 35. No assignment of the shares would have occurred, and if you notice here, the cell highlights in green with the message repeat step 1. The strength of this application is in its ability to progress through a series of what-if stages and adjustments as the underlying instrument, in this case a stock, swings around in price. Let's hypothetically populate the platform with a value of 32 in the ending stock value field. You will immediately notice certain fields light up in red. Given we sold a 33 put strike, and with a hypothetical ending value of 32, we would have to take assignment of the shares. This would require us to change the outcome field from expired worthless to took assignment using the drop-down window. Notice the pop-up warning, outcome inconsistent with results at the top of the screen. With the outcome field now correctly populated to read took assignment, the red highlighted cells warning you of an inconsistent outcome have been automatically removed. Since we hypothetically have now taken assignment of 700 shares, which is automatically calculated, we can now move forward to steps 2A and 2B. Notice the progressive leg price, which is 32, values automatically populate from the end stock value, which is 32, which you, the end user, entered at the end of step 1. Step 2 is a two-part step, if that makes sense. Since we were assigned 700 shares of SanDisk, this strategy immediately looks to generate cash flow in the portfolio. To do this, we sell call contracts, 7 of them, against our long shares. Simultaneously, we sell an additional 7 put contracts at a strike price below the new current value of 32. We have sold the 35 calls for a price of 88 cents, providing us some upside profit on the stock should it rally. Remember, our break-even on our share assignment is $32.27. This is generated by taking the strike of 33 minus the premium we received of 73 cents, which gives us our progressive leg break-even of $32.27. This, by the way, has provided us with 9.73% downside protection from the opening price of $35.75. We also sell the November 30 puts for 97 cents. This step now generates a second credit in step 2, 88 cents on the call sale, 97 cents for the second put sale for a total of $1.85. Selling a second set of put contracts obligates us to potentially having to purchase another 700 shares. 7 contracts is automatically calculated. Should we be assigned, we have effectively dollar cost averaged into a position through a combination of premiums plus assigned share prices at their individual strikes. Our progressive leg break-even has now been reduced to $30.42, and this is prior to taking the second assignment, or 14.91% less than the starting value of $35.75. Notice the red alerts. This is because we have populated the outcome dropdown incorrectly. We entered a hypothetical stock value of 29. This value, remember, encompasses 2 rows due to the fact that step 2 comprises of 2 steps, the sale of the call and a put, which of course is less than the 30 put strike sold. SanDisk cannot close both above the call strike and below the put strike on the day of expiration. It is an either-or outcome. It could, however, finish in between, which would validate an expired worthless outcome for both the calls and puts sold. In this example, we have SanDisk closing at 29, below the put strike. By correcting the outcome to took assignment, the red alerts disappear, indicating that the application is correctly populated. The end value of 29, which is a user-defined input, is lower than the 30 put strike sold, causing the second assignment of 700 shares for a total long position of 1,400 shares. The progressive leg price for both steps 2A and 2B in black are populated on the chart. In step 2, the progressive leg price is the same for both the call and the put, given they are part of the same step, which is step 2. The progressive leg break-evens for both steps 2A and 2B are shown in brown, are populated on the chart immediately to the right. Their values are different given they reflect the cumulative premiums collected for each option leg sold. So $31.39 after the 2A call has been sold, and $30.42 after the 2B put contracts have been sold. In this hypothetical example, we will take this trade one additional step. We now have been assigned twice by having the shares put to us each time the price of SanDisk continued to fall. We are now long 1,400 shares of the stock, with the stock at 29, which is just a hypothetical value. Our percentage move protection since inception is now 21.25%. That's impressive.